All right. So, hi, everyone. We'll go ahead and get started. My name is Kenya. I am the co chair for the Financial Literacy Committee. I just want to say thank you so much for joining us today. We are in session three, our final session of our financial literacy series. We're so grateful for all of you guys who've been here with us for the previous two sessions. The sessions are recorded, so if you missed any of them, you can go back and take a look at them. We'll have them up after this session and we'll get them out to you guys. So today for session three, we'll be talking about mortgage products. We have the amazing Houtan Hormozian here, and he will be speaking to us on some mortgage products. Houtan is one of the most amazing lenders you can come across. He's been in the industry for over 2 decades. And he's accomplished so much in wholesale and retail operations. He's currently serving as the president of the California Association of Mortgage Professionals for 2022 and 2023, also known as CAMP. And he's the treasurer of its Northern Los Angeles chapter. He serves in Woodland Hills, the Warner Center Neighborhood Council, and is currently chairing the Public Safety and Transportation Committee for the council. He is an author and a contributor for Scotsman Guide and the National Mortgage News, the industry's leading resources for news, information, and connections. He's an entrepreneur with nearly 2 decades of accomplishment-laden experience in the real estate and mortgage industry. Houtan's experience centers around brand development and recognition, product launch, market share, distribution, expansion, and operations efficiency goals. He brings valuable insight and knowledge regarding the leadership and management challenges and the challenges that riddle startups and growing companies and brands to the table every day. Recognized as a top producer, he has over $1 billion in origination and has been interviewed by several publications, including Voyage LA, which has identified him as an up-and-coming professional who is changing the face of the financial services sector and related industries. Houtan began his career in the electronics industry, focused on sales, marketing, and growth. His keen business sense allowed him to take a small electronics store and convert it into a multinational import and export business with a highly credible reputation. Pretty much, Houtan is amazing. So today he'll be speaking to you about some of the products that he offers, and I am so excited for you guys to soak up this information. So Houtan, take it away.
Oh my God, thank you. I should probably read my own bio. I was like, are you talking about me? I want to meet that guy. I like him. I should probably thank the person who helped me write that bio. Wow. Well, thank you. Thank you for the warm, for that amazing read. And I'm humbled to be here and among a bunch of amazing professionals. For those of you guys that don't know me, I'm a mortgage advisor, or I like to call myself a mortgage advisor. My specialty for the past almost 2 decades has been helping first-time homebuyers finding solutions that helps them accomplish their goals. And it's truly an amazing feeling when you get that we're closed notice from the title company, because you can see the smile on the consumer's face. So we're in a very rewarding, both financially and emotionally, industry. It's amazing. Don't want to take too much of your time, so I'll start a dive right into the presentation, and I'll try to go as efficient as possible, and we can go ahead and talk about the questions as they come up. Kenya and Jonathan, thank you both for being here and helping me with this presentation. Feel free to jump in, help, guide, and let's get this session on the road. Purpose of this call is kind of providing clarity for the real estate professionals on what we look for within the mortgage industry. There's a lot that goes into the process outside of qualification. On the surface, it's not always about what's your FICO score or how much money you make. There are a lot of little intricacies that we look into to determine the consumer's ability to repay their mortgage. What I always say is, within the mortgage industry as a lender, we're not in the business of foreclosing. the investors are in the business of collecting interest. So our fiduciary responsibility is to both the consumer and the investors. We want to make sure consumers are in a good position and a healthy position, healthy financial position. And our fiduciary responsibility to our investors is to make sure they collect the monthly interest that we're promising them. So going through the process, I mean, my presentation is kind of designed for first-time homebuyers educational seminars, but I took out a lot of stuff that were consumer and left it for what the customer, you guys as professionals would want to know about. As realtors, you guys always know why consumers want to buy a house. So price will obviously continue to go up. Mortgage interest rates are always changing. Differences between paying someone else's mortgage versus your own. One of my favorite, buying a property is almost a forced saving. It's almost always forgotten. A mortgage payment has two component to it, a principal component and an interest component. The principal, I like to call it a forced saving, the money that goes back into the homeowner's equity. So that is always something that a lot of people forget about when we're talking about one of the main benefits of the home ownership is the forced saving that brings in. Tax benefits are of course there. And lastly, and one of the most important one, is to call it a home, to make it the way you want to do it. Let's dive right into what we look at. When we're talking to the customers from the starting point to the finish line, our job doesn't start when the loan is funded. And in this sense, I like to say our job kind of starts right after the loan is funded. We want to set them up for success. We want to help them to be successful homeowners and accomplish their future goals. So within the consumer platform, when we talk to consumers, we look at that and talk to them about the pre-planning. What do they need to do? Not everyone that says I want to buy a house is ready to buy and pull the plug today. Sometimes we have clients that go through the emotion of buying the property, saving, fixing credit, whatever else that they need to do, anywhere from 3 to 12 to 24 months. So the pre-planning is very important, in my opinion, from a consumer standpoint, to make sure they're doing the right thing. During the process, the communication between the lender, realtor, title, escrow, inspection company, and everyone else that is involved is crucial to make sure we have a successful transaction. And after the aftermath of home ownership, what do they need to expect after the close of escrow? We're just not going to hand them over the key and say, you're on your own. Let's be a resource for the consumer and make sure we can help them and guide them after the closing on challenges that they will come up with, especially for first-time home buyers. A lot of times, first-time home buyers will have garage door breaking down, plumbing issues, electrical issues. So those are the things that within the professional industry, we want to make sure we help them. Pre-planning is what we, within the mortgage lending side, we deal with one of our biggest challenge. Down payment is one of them, making sure they have the cash to close, how they manage and maintain their credit history information, and the goal and research that they need to do. So not to dive in too much because we only have 1 hour, we kind of created a slideshow where it talks about what items do we specifically touch on when we go through our credit counseling and homeownership guidance with consumers. And these are open to questions. So you guys as realtors, if you want to know more about any of these specific topics, just go ahead and raise your hand or throw it in the Q&A. And I have the amazing Kenya, Jonathan, and Teresa back there, basically monitoring the questions so we can get them answered for you. As a lender, here's what I always say. Monthly payment affordability is my biggest option and challenge. You can come to me and say, we want to buy a house, and how much can I qualify for? Well, it is my job as a mortgage professional to get creative and get you qualified. But does that mean that qualification number, that qualification payment is what your comfort zone is? Let's say I can qualify you for $10,000 a month on a monthly payment. Doesn't necessarily mean you as a consumer want to go ahead and pay $10,000 a month, right? That's one of the questions that we always have the debate with our consumers and educate them on, to make sure They understand the difference between how much they qualify for versus how much they're comfortable and they can afford to pay on a monthly basis. Cash to close. This is an important part because a lot of time people get surprised on the last minute about how much money they need to bring in. When we talk about cash to close, I always want to mention and tell the consumers that there are three main components to it. There is their down payment requirement, there is a real estate closing cost, and then there's a prepaid items. And the reason we break it down for you guys and real estate professionals so you could educate your customer is the prepaid items are regardless of whether they get the loan or not. A lot of time when they're buying a property taxes, homeowners insurance, assessments may be there. So a lot of time people always confuse that, well, why do I have the prepaid items if I'm buying a property? That's almost forgotten at the beginning of the transaction and it comes up. So it is important to talk about them. I always say a fully cash transaction will still have certain prepaid items as a closing cost that needs to be accounted for. So this is where the real estate professionals like yourself will work with the title company, escrow company to determine what those estimated prepaid items are. So there won't be any cash to close shortage and any surprises, more importantly, for your customers. Credit history and information, I always like to say there is more than FICO score that we look at. How did we get to that FICO score is crucial. Just to give you guys a quick example, if you come to me with a borrower that has an 850 FICO score but has absolutely zero credit history, no open trade lines, no previous loans, credit cards, anything like that, we are going to be limited to the number of products that we could offer that customer. Just because they have an excellent FICO score doesn't mean their credit history meets the lender or investor's requirements. And then goal and research. Well, obviously, you guys deal with this more than anyone else. What type of property, what location, how long do I want to keep it, and all that stuff. Those are something that you guys and the customer will decide. And then it comes into picture for us on the lending side, because based on the client's goals and research is what we decide which mortgage programs are best offered to them. If we're looking at a short-term loan, a bridge loan, or a long-term 30-year fixed loan, all of that will depend on that initial consult. During the process, these are what we recommend to consumers, and we want the real estate industry to know about it. Things that we look for to make sure we avoid, not to become a surprise. Changing employments, losing employments, acquiring a new auto loan is one of the most common issues we experience. We want to make sure that consumers do not open a new trade line with high credit limits and high credit balance that could hinder their mortgage qualification. Maxing out existing credit card. A lot of times customers get excited about buying a property, so they start shopping in advance for furniture, whatnot. And that could also damage and affect the credit qualification that we've gone through. And stage 3, after. This is what we usually talk to customers, especially first-time homebuyers. We work with our real estate professionals to make sure we're all on the same page on educating the clients, maintenance and upkeep of the property, supplemental property taxes statement. This is one of our biggest complaints that we receive anywhere between 3 to 9 months after the homeowner takes possession. That's when a city assessor will send them a revised tax bill that says your tax is X amount of dollars. So this is something that we talk to the customers, educate them, and let them know to expect and anticipate an increase in what they may be paying on their property tax. It is, you guys know how it works, but this is something that we want to go ahead and always talk to the customers. If you guys have any questions, we actually have a written article about letting the customers know. It's something that we provide to them at the closing, the reminder, what to expect and why it happens. How does the property tax supplement work? Annual increase on insurance and taxes and HOA. We often say this is a fixed monthly payment. But what we're referring to is actually truly the mortgage payment being fixed for 30 years. What we don't have a control over is the property tax being increased 2% a year, homeowners insurance being changed and revised annually by the insurance provider, or if the homeowners association decides to do increase on their monthly payment. those are the things that will change. So we want to go ahead and make sure we let the customers know what to expect years to come. And then we always say, go ahead and ask your real estate agent or mortgage broker if you don't know how things work, so you could get properly information. Let's see, fulfilling the dream. This is the dream of homeownership. So I would say this is where, on a real estate and mortgage team collaboration, we work almost seamlessly together to deliver that experience to the customer, to the homeowners, whether they are a first-time homebuyer or coming back. That's something that we want to go ahead and make sure we collaborate. So I'm just going over the participant list, and I see a lot of professionals here. So I don't think I need to go and dive into the idea of homeownership dream. I want to make sure we save our time for and use it best. So for Q&A, I think would be the best resource. So I'm going to skip over some of these slides. If you guys see a slide that you like, go ahead and raise your hand, pause me. We can discuss it, but I will go ahead and skip over the ones that are generally used and everyone knows. Home prices. Well, this is slide right here. I would say it's about 2 months old. I haven't had a chance to update it, so numbers will look a little different than what we're experiencing in today's market. You guys have all seen it. There are certain areas of the country that prices have already dropped as much as 25%. Arizona, Utah. There are some other states that the property value appreciation either has stopped or has drastically dropped. So I apologize for that number being at the end saying home prices are expected to rise by 4.7%. This is based on the last data that we had collected, but we can get into the nitty gritty of how today's market is doing. One thing that is almost certain is when interest rates increase, that will affect the mortgage monthly payment, how the principal interest payment works, and how we are anticipating that the rates will continue to increase. That increase will cost consumers thousands of dollars. For demonstration purposes, rates between 5.25% to 6.5% will cost the consumer almost $52,000 in additional interest payment over a 10-year tenure. So when we talking to the customers, rate is crucial. We want to make sure we educate the customer the benefits and pros and cons of a higher rate versus lower rate. It affects directly with the property values, but it doesn't affect the mortgage payment. And that's where people are questioning, well, what happens if the property value goes up or property value goes down? It doesn't matter. What matters is what your interest rate on your mortgage balance is. A lot of first-time homebuyers get confused on, well, if the property value goes up or if the property value goes down, am I losing? Neither is there. There's no right or wrong answer for it. What matters is if you don't purchase the property today at the right interest rate, how much of the money that you're paying on your rent directly affects your savings as opposed to owning a mortgage. It's a paper transaction. When they buy a property, and I know one of the most common questions that we're getting on a mortgage side is, well, I'm not going to buy today because what if the property values go down? Very true, it might happen, but does it matter? As long as you don't sell your property, you're not taking on a loss. As long as you're paying the rent, you are taking on that loss. So it's a common math question when it comes to step one of the planning: tax savings, forced saving, and benefit of owning the property. Some of the items that we share with our consumers is rent versus owning. These are the most common benefits that we can explain to the customers. So we go through them very briefly with them. We are not tax advisors, we're not tax accountants, we're not real estate lawyers. So we don't get into the nitty gritty, but we provide them with options so they could go ahead and reach out to the right professional. One of the most common questions I get is, I get asked because we do the mortgages is, well, how much benefit will I get on my taxes at the end of the year? And unfortunately, I can never answer that question because there's, as you guys know, there's a lot of variations into how the tax does. So how the taxes get calculated and how it will benefit them. So we always refer them to the trusted professional. We always revert them back to their own accountant or their own CPA. We do provide the numbers. So we want to make sure we're as transparent as possible with them so they could get the most accurate answer. But we do simply say, go back and talk to your accountant because they are the one that matters. Now, talking about the mortgage programs and product, this is how we get into the process by itself after having that long conversation with the clients. What is it that we look for? Income. And it's just not a matter of how much money they make today or how long have they been working. We also look at the stability of that income. There are many different incomes. There are many different type of incomes that can be used for different type of mortgage programs. Simply put, it could be their ordinary income. It could be their investments on the stock. It could be their passive income from real estate earnings. It could be their pensions or retirement accounts. Doesn't matter what it is, income is usable, but what also matters is the continuity of that income. Just because they have that income today doesn't mean they will continue to receive it. To give you guys an example, we can utilize applicants' retirement income off of their 401k. So they don't necessarily have to be employed today. So stability of the income, stability of the job is what we're looking for within the mortgage products for ability to repay. So this is why we always go back and say, within the mortgage side, don't just discount the client. If they call you and they say, oh, I don't have a job, don't just shut it down right there and then, because there could have other means of meeting the requirement for the income stability. Collateral, asset and appraisal. So just because someone has a job, does have the down payment, doesn't necessarily mean they can get any type of loan they want. This is where the creativity comes in. Within the mortgage side, there are hundreds of different mortgage programs available for different applicants. There are programs that purely drive off of the collateral, which being the real estate asset itself. Has nothing to do with their income, has nothing to do with their FICO, but it has different programs. So the three components that we have listed there, income, collateral, and FICO, while they work hand in hand, they could also work independently. On a mortgage side, we always recommend reach out to your trusted professional and let them do the discovery call. Calling them and saying that there's a client that has a bad FICO score might not benefit that consumer, or calling them and saying they have a perfect credit score. Again, does not mean anything to us on a lending side. Good credit history is far more valuable than just a FICO score by itself. We've had clients that have been turned down for loans with a 720 FICO because their credit history was spotty. Their credit history was not meeting the requirement. And we've fund borrowers on a 580 FICO score, on a 560 FICO score. But there is a reason the FICO score is low. We understand that. We make sense out of it on a lending side, and we accept that risk. We understand that the 560 FICO score does not mean a bad applicant. It just means a special circumstances. So the three of them, stable income, asset appraisal, and good credit history, almost go hand in hand while they go independently. So we want to make sure that the client gets the right mortgage program as we do the interview. What do we look for? Or I should say, what you need to know when you talking to the customers and trying to gauge their interest about buying the property. So credit history is crucial. But why do you want to know the credit history? Is because you don't want to be surprised by you don't want to have any last minute surprises. To give you guys an example, we've had clients where when we pulled their credit, was a perfect credit history, was a perfect FICO score. What they neglected to tell us is a car loan that they had co-signed for their cousin just went into default because that individual did not make the payment. That will affect us at closing because literally 5 days before the loan is funded, we are obligated to do a recheck on the credit to make sure the consumer has not increased their credit card debt, the consumer has not missed a payment, the consumer has not gone into default on any of their existing liabilities. So this is where knowing the credit history and score in advance and having that open conversation with the customer comes in handy, because you could anticipate the issues throughout the process and you could be proactive about it and make sure the customer and everyone else is educated on what to do. Documentation, well, income verification, credit history, bank statements. Technology is changing. I can tell you this. A lot of times nowadays, we don't ask for customers' pay stubs anymore because those numbers are provided to us through Work Number, which is a verification system. We don't ask for customers' bank statement. They are provided and downloaded automatically. So the documentation process is getting easier. But one thing that will probably not change is the verification of income that is provided by the employer. A lot of times consumers have different source and different type of incomes, overtime, bonuses. I'm just drawing a blank on this one right now. God, there's 5 or 6 different type of incomes that an average customer could have. And then once we get into veterans, they have many different type of income that get categorized. So on a lending side, because we want to make sure we are doing our job properly and making sure the customer is truly eligible and have the ability to repay, we request a specific form from the employer to be completed and sent back to us for verification and calculation. That probably will not change, which is the verification of income and employment of the borrower. One of the most important and challenging part is making sure the HR department or HR sources within the employers, they provide that document to us. So as you're talking to your clients, please make sure they understand that they provide their lender with the right contact information. Contacting the professional, well, this is where you guys come into the picture. You guys are the front line. You guys will provide the resources to your customers, tax accountants, lenders, CPAs, and anyone else that you guys deal with, right? Title company, right? Escrow company, right? Notary, and all that stuff. So these are the basics that will happen upfront. And talking about income eligibility, contacting the loan officer, making sure that loan officer has done their due diligence upfront will save you guys and the consumer a lot of heartache and headache. Don't just rely on a verbal verification. Make sure that loan officer actually takes their time to review tax returns, pay stubs, or income documentation as needed to avoid any surprises. And lastly, well, the difference between a pre-approval and a pre-qualification, that is very crucial. I would recommend to stay away from the pre-qualifications in today's market and go with a full force approval letter. A full force approval letter is basically a client that has been income and credit qualified. The only thing that is pending is the collateral, which requires the appraisal. A client that is pre-approved through income and credit qualification has gone through a full underwriting. They've gone through verification of almost everything that you would think of, just like a full approval. That's what we do recommend. Skipping through some slides here, getting qualified. So this is where I was talking to you guys about different mortgage programs and different FICO scores and qualifications. With as little as 3% down or as low as 550 FICO score, there are mortgage programs available. They will come at a cost. The rate might be higher. The qualification process might be lengthier, but there are available programs out there. So when you're talking to the consumers, If you get the sense that they're worried about their lack of down payment or they're concerned about not having enough money for the down payment, always know that there is a resource out there. This is a quick slide of the process of purchasing a home, qualification, finding a home, processing and underwriting. This is probably the most lengthiest time. If you are a new real estate agent that haven't done a transaction, this is the part, step 3, that we say you should be patient, because we want to make sure we provide the right answer to you guys as real estate professionals and to the consumer. The processing and underwriting the reason it takes time is because we want to make sure we cross all the T's and dot all the I's. Underwriting approval is done, and that's when we go through the process of actually the closing document, which is the trust deed, loan documents, and final closing stage. Right, pre-qualification on credit. What do we look for? There are 3 important credit bureaus: Experian, TransUnion, and Equifax. It is almost important to mention that no one can run anyone's credit without a full consent. As a mortgage broker or as a mortgage lender, we must have either a verbal or written consent from the consumer to be able to pull their credit. Just because we get their application doesn't mean we are allowed to run it. It would be a huge fiduciary violation if anyone does that. So it's good to have that conversation with them. And talking about the FICO score, there are many different versions of credit history. This is probably what you guys will experience on your front end. Well, you get the customer saying, I have an excellent credit history of 800 because I saw it on Credit Karma. And when you hand them over to the lending side, they come back with a 680 FICO score. And that's where the debate usually starts. So this is a good part where we kind of start with you guys to let the customer know, don't pull a Credit Karma. Don't go through the free credit checks, because most often what happens is the credit version that those individuals or those entities are using is for advertising and marketing purposes, and is not the FICO score version that is used on a lending site. It's important to make sure the consumer understands that, because we want to avoid having extra credit inquiries on the customer. And we also want to make sure we don't put the customer in a situation where they feel uncomfortable after seeing the amazing 800 FICO score through Credit Karma and getting a 680 FICO score from their lender. Pre-qualification on a credit, what do we look for and what we don't look for is really dependent on a mortgage program, a mortgage type. I'm gonna do a little pause here and give our attendees an opportunity to come and ask questions if they have any on the credit. So if there is any question that you guys want to know specifically about credit, please go ahead and put it, either raise your hand or go ahead in the Q&A section or in the chat section so we could get it for you. Kenya, you've been awfully quiet in there. I know we've had 2 other sessions. So let's try to incorporate what we had in other sessions on the mortgage program side. What are your thoughts? What kind of questions have you come across?
So we've mainly got questions regarding the specific programs that are coming up and how they're going to affect the housing market going forward. I know a lot of people are asking questions about the new mortgage program through Bank of America. So, more specifics as to how it's going to affect our market going forward.
Okay. Hey, Jonathan. Good to have you on the camera.
Hello. How you doing, Houtan?
Good. How are you?
Good. And when you're done addressing Kenya's, I also have another thought or two, but I'll handle that first. And then, if nobody else has anything, I've got a question as well.
Sure. I see Andy has his hand up. Andy, do you have a question? Do you want to put it on a chat or do you want to ask it through the Q&A panel? I don't know, because you're muted, so we can't hear you, Andy.
Andy, you should be able to unmute yourself now if you can.
Can you hear me now?
Yes, we can.
Okay. You mentioned that you run the credit on an individual maybe several times during the process of getting them um, qualified. Now, the problem with the scoring agencies is that every time you run a credit on somebody, your credit score goes down. So if you run the credit on them several times during the time of the loan transaction, we're getting them qualified and so on online, doesn't their credit go down?
Great question. So is there a follow-up, or would you like me to answer it now, Andy?
You could answer it now.
Okay, so there's two components. One, I think it was throughout the 2008, and I don't remember exactly what year because it's been so many years ago, a law was passed. When a mortgage company pulls credit, the consumer has the ability to run credit as many times as they want, which is it's allowing the consumer to shop around within 45 days and run their credit as many times as they want without affecting their FICO score. So what happens in this instance, and this is why I was telling you, avoid having your customers run their credit on the free credit checks or Credit Karma, because every different industry has a specific code to run their credit. So when we on a mortgage side run the credit, we use a specific code and letting the bureau know for what purpose it was ran for. Based on that code, consumer has up to 45 days to run their credit as many times as they want without the FICO score being affected again. So it doesn't affect them. They can shop with as many lenders as they want and have as many hard inquiries as they want within 45 days. But the second part of the question is, when they're working with one lender, within the mortgage industry side, we have a secondary credit pool functionality, which is not to pull a whole new credit. It's a refresher that we run throughout the process to make sure credit cards balances have not changed. There's no new derogatory items being reported. So it's not a full credit check. It is a refresher as a security to ensure that there's no unexpected credit reporting, and it does not affect them. The refreshers do not affect the consumers whatsoever. So I hope that answers your question. And then I see Frank has a question. With COVID-19 and layoffs during 2020-21, are buyers' employment history being or affected? What are the underwriting to adjust employment gap to do COVID? How does the employment gap affect their credit repay? Okay, Frank, so the gap on the employment does not affect their credit rating. It does affect their employment history. The only way I can see affecting their credit rating is if they happen to miss a payment due to lack of funds on making those obligations met. So it doesn't affect the credit rating. How do we look at it on the employment side and the employment gap? There is a policy in place where as long as the consumer is back at the same job with the same pay, there are exceptions to be made. So if the employment gap is more than 6 months, which was the acceptable allowable employment gap because of COVID, there's almost no questions asked. If it's more than 6 months, what we look for is the employment stability. So if the consumer was a teacher, teacher not a best choice. Let's say they worked at a retail, and because industries change, they got laid off, and it took them longer than 6 months to go back to work. Now they're back at the same type of employment with the same pay structure, meaning they were getting an hourly, and now they're getting hourly again. It didn't change from hourly to commission. It didn't change from hourly to bonuses. With reasonable explanation as why it took him longer than 6 months, again, lenders will make exceptions. Our job from a lending standpoint is to make sure we provide loans to consumers. We want to make sure that we go ahead and get that customer's need met and get the loan happen. The only time that we are hesitant on writing a loan and funding that loan is when we are not confident in the consumer's ability to repay. So if they change industries and now they're 2 months at a whole new job with a whole new different pay, that becomes a red flag for us because we don't know if the client will be able to continue with that job. Outside of that, it's always, as long as it makes sense from a lending standpoint, we will go ahead and make sure that loan is written and the loan is funded. So I hope that answers your question. Kenya, you brought up Bank of America's new loan program. So it is a very interesting product that is being marketed again. These community-based programs have always existed. They have a lot of limitations and caveats within them that must be read. So the most important part about this Bank of America loan program, initially when they rolled it out, I think it was at only available in 5 specific MSAs. For those that don't understand what MSAs is, so basically every county, it's kind of like a census for tracking of who lives in what area, what type of income they have. So it was initially rolled out within 5 MSAs or 5 cities, and now they have expanded it to 28, I believe. The short for that program is, I would say, it's designed to help communities where they don't have the ability to save money due to high rents or high cost of living, and that their FICO score is damaged due to lack of financial responsibility or financial literacy, however you want to put it. So the program eliminated these 2 important factors: credit and down payment. You are still responsible for the income portion of that consumer. And again, it goes back to ability to repay. So one important key phrase that we always use within the mortgage industry is the ability to repay. If we don't check credit, if we don't ask for down payment, if the interest rate is 0, there is still a monthly payment for the amount of money that is being taken out. If you take out a $500,000 loan, just for the sake of numbers, let's say their monthly payment is $3,000 a month. The ability to repay component is there to ensure that we put the consumer in the right mortgage program. So can the consumer pay $3,000 a month in a monthly payment if they are not putting any money down and if they don't have any good credit? So the Bank of America loan program that is being currently offered is great for certain communities, but the ability to repay is not waived. So that is to be considered. I can say this from experience in areas like Los Angeles, where the property values are so high, the ability to repay is always the biggest obstacle we have for the first-time homebuyers, because the monthly payment just does not match the income requirement that usually are set forth for certain programs. Jonathan, you had a question you wanted to bring up?
I did. It was more related to interest rates, so I wanted to save that until after you finished the credit discussion.
Oh, my favorite topic, interest rate. Ask me, go ahead. What's the interest rate today?
And not specifically that, but how much have you been seeing different programs or propositions where there's a buy down of the interest rate from either the seller or a buyer? Have you been seeing that? Do you think that's an effective tool? Maybe just hear some of your thoughts about that for folks who are really concerned about why interest rates going up.
Sure. So yes, we have been getting a lot of inquiries about the 2-1 buy downs programs that are being offered. I personally am not a fan of these 2-1 buy down programs. the way I treat them is very similar to the negative amortization programs that were offered back before the mortgage crisis happened. My explanation and my logic behind it is if the consumer cannot make the fully payment today, what guarantee can we give them as their trusted professionals that they're going to be safe and secure in 2 years when the payment is adjusted by $1,000 or more? We're talking about, so I'm in Los Angeles. 95% of my fundings are in Los Angeles. So when I use $1,000 number, I don't mean to scare people off, but I'm just going off of the payments that is affected off of a $600,000, $700,000, $800,000 mortgage by a 2-1 buy down. So to me, I don't want to say it's a risky program, but it could be risky in the wrong hand. Most people don't know negative amortization programs that still exist out there. It's not offered to general consumers because of what happened through the 2008 era. We still offer these programs to our highly educated and savvy investors on the portfolio product, on the portfolio side. We just don't offer it through the general mortgage program on the traditional financing. So the 2-1 buy downs, again, are very similar, in my opinion, to the negative amortization programs because they give that false sense of affordability to a first-time home buyer if not properly explained. And then lastly, what do we know about what could happen in 2 years, right? It's a long way, employment-wise, economy-wise. So I strongly discourage my clients from the 2-1 buy down unless I know they're very savvy in money management.
And Houtan, just if I can back you up a little bit, I know we have quite a few people on the call vesting in experience. So can you just talk to us a little bit about what the buy down is and exactly what a 2-1 buy down may be?
Sure. So the program is designed where, in general, what we do is we calculate, we come up with the calculation on lowering the monthly payment by 2% for the first year, 1% for the second year, and then on a third year, it goes back into the fully fixed payment. So what happens is when a customer comes in and we do the 2-1 buy down, the first year, right as soon as they get their mortgage, the payment is lower by 2%. That seems a lot more affordable. So a lot of people get excited about it. The way the program works is essentially through negotiation, someone will pay that difference on a monthly payment for the first year and second year upfront. So on average, in California, in Los Angeles, we're talking about anywhere between a $15,000 to a $30,000 upfront closing cost, because for us as lender, we're not giving you a discount. What we're just doing is we're just allowing for someone to pay the difference between you as what a consumer would pay versus what the true monthly payment is. So that is done through negotiation, usually through seller credit or seller concession. So the consumers may not notice it upfront because it was done as a credit, but comes 12 months after, they will see that their monthly payment increased by 1%, and then comes 24 months, they will get a kind of a sticker shock because now they have to make the fully payment.
Amazing. Thank you so much for explaining that.
Sure, thank you. All right, so I don't see any more questions or hands up. So let's talk about FICO breakdown. There's no true science. So what you guys see on the slideshow, please don't hold me to it. This is just our best guesstimate provided to us by a credit expert out there. This is how they kind of explain to us how a FICO score is determined based on what criteria and what factors. And this is what they provide for us. And as you guys can see, one of the most important factors on what affects or drives your FICO score is your payment history. Excellent payment history has the most amount of impact on the FICO score. I've seen firsthand where we pulled a client who had a 700 plus FICO score to drop down to low 600 just by simply missing one auto loan payment. And They were just 30 days late. So it is, I believe it when they tell us, when the credit expert tell us the payment history is the most important part. Length of the credit history, how much you owe. So the lower your balance is on your credit cards, as the higher your FICO score looks like to be. And to me, it makes sense because it shows your financial stability, shows that you have the ability to take care of the obligations you take on. And then opening less credit scores, or making sure that you keep the longest, the credit card that has the longest history. Those are also important. But again, don't quote me on it. I don't think anyone out there truly can tell us how the computer algorithm is written to calculate your FICO score. It's just all automated. Income. So these are some of the items that we look at, but again, they're not set in stone. For income process, what we're looking for is 2 years of employment history. But just to give you guys an example, there are circumstances where the 2 years employment history can be driven by other factors. Someone who just graduated from a professional school, their school history can satisfy their employment history. Doesn't necessarily have, employment history does not necessarily mean income history. This is where the stability of the future, the income stability comes into picture by the employment history. Someone who goes to an accounting school, graduates with a professional degree, and gets a job at an accounting firm can obtain a loan almost immediately after graduation, because what we look at is they went through 2, 3, 4 years of education, and now they're studying. After their studies over, now they are working. So the likelihood of their employment stability is very high. But if someone goes to a nursing school and they come out and they decide to become an accountant, that will become a problem, because now they're changing industries. It kind of works the same way when someone who was employed and hourly quit their job and now they become self-employed as a real estate professional, right? It's a completely different industry. It's a completely different opportunity. So employment history is crucial to obtaining the loan. How do they get paid? Is it salary, hourly? Is it commission-based, bonuses? How often? And all of those matters. We look at those because we want to make sure that their future income is stable. Down payments. This is where we always talk about clients, because some may have money that they don't even know they could use. One of the most common forgotten source of down payment is the 401k and retirement funds. Most people are under assumption that they have to liquidate or close their 401k. That is actually not true. They can get a loan. Well, let me put it bluntly, and this is almost where it gets very interesting for a lot of people that they didn't know. When you take out a loan from your 401k, you're giving yourself a loan. So you're actually earning interest while you're giving yourself a loan. You're becoming your own lender. It's a very interesting calculation behind it. Don't want to get into it, but always let your clients know if they have a 401k, they should not shy away from reaching out to their 401k company, to the retirement company, to inquire about giving themselves a loan to purchase a property. It is beneficial in more than one way. So it always helps them. Gift funds are always acceptable for majority of the loan programs, as long as it's not an investment property. You cannot use someone else. The concept behind an investment property is we're talking about someone who's savvy, someone who's educated. So if they want to go ahead and invest, that means they have a very good money management process in place, and they should not have a need to borrow money or get a gift from someone else to secure the requirements for the down payment. 1031 exchange, I know this is Jonathan's most favorite topic, but when you're doing a 1031 exchange, the proceeds from the sale can be used to meet the requirements for down payment. It's very easy. It's already sourced and seasoned, and of course, checking saving. So that goes without saying. Different programs, different down payments. So down payment assistance programs, we have it as 0, but reality is you can actually, if the consumer is eligible, they are mortgage programs that they can go ahead and even get help with their funding. So down payment assistance programs are great tools for certain areas and certain neighborhoods. I can tell you from personal experience, in Los Angeles metro area, this is going to be difficult, but we use this program on many different other areas where affordability is still very doable. And then the higher down payment you put, the more favorable you look in front of your investor or lender, so you can get better interest rate, more favorable terms, and higher negotiation leverage with that investor. There are many different down payment programs, Cal HAFA plus ZIP. This is the one that I was referring to, where you can get down payment and closing cost assistance. Pre-qualification and pre-approval process. We did touch on this very briefly. I recommend make sure you go with the pre-approval process. You want to make sure your client's income, credit, and asset is reviewed and secure, as opposed to just having a verbal agreement. How do I get pre-qualification? Well, this is where your guys work with your preferred lenders and mortgage professionals to make sure your clients are taken care of and secure. And I think we are almost at the end of our presentation. So I will go ahead and sure, Gina, let me know when you want me to stop. So I'll go ahead and stop the talking and open the last few minutes for Q&A if you have any. Gina?
Yes, could you go one further, one ahead?
Where we had the different down payments?
Yes, thank you.
You're welcome. We have a few minutes. Any interesting questions that have you guys seen? Honestly, I talk about mortgages all day long. So to me, it's like everyone knows everything. I don't need to mention it because this is what we do. But oftentimes find myself that what I do know is not always out there. So any questions? I see Andy.
Gina has her hand raised, actually. It looks like she might have.
Yeah. Can you hear me? I don't know if I'm unmuted.
Yeah.
Oh, what about ITIN? Are you dealing with any ITIN programs?
We are dealing with ITIN programs. Just for those individuals that are questioning if they don't know what ITIN is, individuals that come to United States and have a work permit or work visa and stay here are not issued social security numbers because they just simply are not considered in that category, but they have a specific number that allows them to file taxes. So any individual that files taxes in the United States is eligible to get a mortgage. They're just different mortgage programs. We do have few investors that do ITIN programs. If I'm not mistaken, right now, based on the current climate, the minimum down payment requirement has been increased to 20%. If you had called me a month ago, I would have said we have ITIN programs that are doing it with as little as 10%. So there are programs out there. Unfortunately, rates are substantially higher than your traditional financing. At a time that we were offering 2.5%, 3% interest rate, our ITIN programs were at 4.5%, 5%. So they are not as favorable, but still manageable.
And do they ask for any like income requirements? What do they base it on?
Well, so if you are a ITIN holder, you are filing taxes. So you are actually providing supporting document like tax returns. There are ITIN programs based off of non-portfolio product, which we could utilize the self-employment's bank statements. They require higher down payment and they have even higher interest rate. In short, the riskier the client gets, the higher the interest rate goes. Yeah. So we do have programs for ITIN borrowers that do not file taxes and only can only provide bank statements, but they have much higher interest rate requirements and down payment requirements. I hope that answers your question.
Thank you.
You're welcome. Andy.
We have one more question from Andy. Yep. Oh, Andy, you're muted if you're talking.
Can you hear me?
Yes.
Can you hear me now?
Yes, we can.
Okay, concerning the down payment assistance program, first of all, who would help the buyer apply for them? Would the lender help them apply for them? And would they be taken care of concurrently, applying for the down payment assistance and then and also applying for their
Regular financing.
regular financing, yeah.
Right. So the individual that they will be working with. So for example, if it was many of the lenders that are local here, and I know a lot of them offer the down payment assistance program. The general process is when we do take the application, we are collecting enough information that we should know the client is seeking down payment assistance. I mean, this is part of the discovery call that I strongly encourage every individual on the mortgage side to conduct with their consumer. And as you do that, when you realize that the consumer has to go through the down payment assistance program, it almost goes without saying that. So we don't want to put the client in an awkward situation and say, hey, by the way, you don't have a down payment. It's more of, well, these are the available programs. This is how we can get the loan done for you. And we do collect those documents that are needed for the down payment assistance side upfront. We do the qualification. When the package is ready, we send it out to the secondary market that issues the down payment assistance. They're only in California. There are a couple of institutions that do that. And then there are some local programs, like for example, if you're inside the Los Angeles city, they have a specific down payment assistance programs that are done specifically for Los Angeles city as well. So knowing the resources help where to go and how to obtain them.
Okay. Thank you.
Sure, thank you. All right, I'm just gonna go through the slides very quickly to make sure we're not missing anything. This is one of my favorite slides, why work with the broker. One of the biggest advantages of the mortgage broker is mortgage brokers are not captive funders, meaning when you work with the mortgage broker, they shop from A to Z. We can fund the loan for the best possible credit outcome out there, and we can also provide privatized institutional loans, hard money loans, where when you're working with the captive funding source, hard money loans and some other programs may not be available. So working with a mortgage broker from the get-go allows the customer to get all the available options to them and not just by what is presented to them. So this is one of my favorite slides. I always recommend making sure your clients go through the mortgage brokers to get it. And let's see, talking about a lot of different programs, but nothing here that you guys don't already know. So this is the favorite slide for realtors. Once the approval is issued, your job begins. And I think my job ends right there.
Until escrow.
Until escrow.
Well, Houtan, thank you so much. This is very informational. Did we have any other questions? I know we've kept you guys a little bit longer, but if you have questions, please use this time and space. Jonathan, did you have anything?
That's all I got. It was a great presentation.
Oh, thank you, and sorry for boring you guys. I know numbers are not fun.
Oh, Houtan. All right. Well, if there are no other questions, Houtan, can you go ahead and put your information in the chat just in case anyone would like to reach out to you specifically to speak more about any programs that you may offer, or maybe ask questions that they didn't get a chance to answer today?
Absolutely. If anyone has any questions, please feel free to call or email, and I'll be more than glad. Copy of this presentation, we can customize it for you guys. Unfortunately, this one is a little, the reason I'll the reason I don't say I will share this one with you guys, because I want to make sure I do not put you guys at risk. There are certain information within this presentation that you have to be licensed mortgage originator to present to the customer. But if you guys are interested, we can definitely work with you to create a slideshow, a presentation that is geared toward your specific needs. And my marketing team will be more than glad to do that for you guys. So please feel free to reach out.
Thank you. And again, this series, as well as the other two sessions, this session, as well as the other two sessions, have been recorded. We will package them together for you guys in SRAR. We'll have them up on the website. If you are interested, please reach out to our board. They can go ahead and get the videos over to you. Like I said earlier, we appreciate you guys so much for joining us, whether it was for one or all three of our financial literacy series. Jonathan and I both hope that you guys were able to walk away with some key points, not just for yourself, but also for your clients, being able to continue building your business and creating the longevity of your business that we all hope to and strive for in the ever-changing market that we're in. If you have any questions, again, please feel free to reach out to any of us. It looks like one just may have come in. However, just a thank you. Houtan, thank you. So other than that, you guys have a wonderful day. Again, thank you so much from the entire Financial Literacy Committee.
Thank you, guys.